Hello everybody and welcome to this video where we'll be running over some of the largest consumer electronic products companies. We have today selected the following 4 companies. We have Apple here, which is obviously one of the big boys, representing in many different areas. However, the biggest part of their business is still the smartphone market. We have HP Inc. here, HPQ stock ticker, which are overly represented on the computer laptop market and printers. You have Dell, which is also heavily represented on the computer business, but also on the enterprise storage market. And lastly, we have Sony, which is obviously big in many areas as well. They have everything from cameras to telephones to the gaming with the PlayStation. Their laptop business they sold off, so they don't have that anymore. So some of these companies like Apple and Sony will come with quarterly reports in this coming week. HP and Dell is going to first be in November and December. First, we want to take a look at whether these companies are in an uptrend and a downtrend. So we can take a look at how the stocks have been performing for the last periods. And as we can see here, Apple is looking quite good. Stock performance year to date, they have gained 57.17%. HPQ is down with 9.59%. Dell is down with 29.56% and S&E is down with 12.03%. So it's looking quite well across the board with the exception of HP. But if you take a look at the simple moving averages for all these companies, they are in the most recent periods actually looking to start to go into a downtrend. And that is very much worthwhile to consider if you are planning to invest in these stocks as of today. Next, we want to take a look at the income part and understand whether these companies are earning money in the end of the day. So we can first take a look at the net income for the last 12 months and we can see it's looking really fine across the board here. All of them are positive. Obviously, Apple here very big with $58 billion. We can also take a look at the net profit margin for the last 12 months where Apple is superior with 21.33, a big example of profitability. Sony followed with 8.48% and HP and Dell are slightly poor with 4.52 and 2.46%. We can also take a look at the BNHM score. We obviously want this to be below 2.2 minus, and it's basically a mathematical model that determines whether a company has manipulated its profits. We can see there's no concerns with any of the companies. The same situation with the Sloan ratio, that is to identify a substantial part of earnings and non-cash accruals. We're not interested in that. So we want this number to be between minus 10 to 10%, and all of the companies are living up to that. So overall, it's looking quite well, but on the margin, Apple superior, followed by Sony. So if we take a look at the overall ranking, we can first look at the stock and the trend. And actually for all these companies, we believe that they are more or less in what we call sideways. There's no clear indication yet as to whether they are moving back into an uptrend or they're going further in a downtrend. So not really any clear indication as of today. On the net income part, all of them were positive. It was looking fine. Net profit margin wise, Apple the best, followed by Sony, HP and Dell. We then move into the return metrics and we want to understand how high returns and cash flow margin is being generated by these companies. So we can first take a look at the ROIC, the return on invested capital, benchmarked against the industry. And we can see Apple has a respectable 18.28%, HP bit worse with 10.41%, Dell not looking that good with 3.35%, and Sony acceptable for their industry with 3.44%. So the sub-industry of Sony is different as they have sold off their laptop business, so they don't follow into the same subcategory or subsector as the other companies, and that's why Sony is still green while as Dell is red. We can also take a look at the levered free cash flow margin. We can see Apple really good here with 26.18%. Sony again doing fine with 11.95%. And HP and Dell are struggling a bit more with around 4 to 6%. Next, we want to go into the balance sheet and ratios and understand how strong the financial position are of these companies. So we can first take a look at the current ratio. We want this to be above 1, and we can see that it's only Apple who is delivering on that, although it is not crazy bad for the others, but it is still not as good as what we would like to see. We can also take a look at the cash ratio and understand how that is compared to the current liabilities. In general, we want this to be above 1. Apple is getting close, pretty poor for HP, pretty poor for Dell, and not so good for Sony in this one either. So far, Apple is looking quite fine. The others are a bit more shaky with some small red flags. You can also take a look at the total assets versus total liabilities. Want this to be above 1.5 in general. Apple, Sony and Dell are doing okay, but HP again has a red flag here. Similar story on the debt equity ratio. Apple looking fine, the same with Sony, really good with 0.13 here, but really bad with Dell on 9.57, and also HP with a minus 3.01. So again, huge red flags for these two companies from this angle, and that's something that disconcerts me a little bit with them. We can also look at the Albert Z score. We want this to be above 1.8. This is based on a credit strength test that assesses the likelihood of bankruptcy. It's looking really good for Apple, decent for HP, and a little bit more shaky for Dell and Sony. I'm a bit surprised with the Sony score still, but that's a little bit of a concern. The Piotrowski score is another way to assess the strength of the company's financial position. We want this to be equal or above 5, and we can see all of them are scoring decent here. So from that angle, looking quite okay. So first we took a look at the return on invested capital, and it looked decent, but not more for Apple. It looked not so good for HP. Sony was, compared to the others, not that good, but compared to its industry or sub-industry, it was actually looking fine for Sony, and Dell was looking the worst of among the 4. We could also take a look at the levered free cash flow margin. Apple doing really fine, followed by Sony doing okay, and Dell and HP was again struggling a little bit on this one. We then went into the balance sheet and we took a look at the title ratio. It was looking fine for Sony and for Apple, and poor again for HP and Dell. Similar story with the debt equity. It was looking fine for Sony and Apple, and really discomforting for HP and Dell. We then want to investigate the shareholder yield and understand how much value is returned to shareholders either through dividend and or buyback. So if we first take a look at the dividend yield benchmarked against the industry, Apple is paying a small 0.69%, HP looking really fine here with 3.72%, Dell is not paying any dividend at all, and Sony is paying a small but good compared to its sub-industry, 0.55%. A similar story on the buyback yield, where it's actually looking well across the board, a huge 8.82% here in HP and a very good 4.71% for Dell. That gives us the total shareholder yield, where all of them are looking fine compared to the industry, but where HP for sure is standing out because of 12.53%, and actually also Sony on 2.23%. The reason for that is if we take a look at the modified payout ratio, which shows the proportion of earnings that are paid to shareholders in the form of dividends and buyback, we obviously want this to be below 100 because it means that it's sustainable, and it means that there's room for growth in either dividend or buyback if the company wants to. So when you see 146.93% for Apple, it shows that this is not sustainable in the long run. However, when you benchmark with the industry numbers, it's still looking quite well for Apple on this, even though it's above 100. The same with HP, 125.7%. It's a bit high, of course, but they can easily cut the buyback yield, and then this will go down to an acceptable level, so no concerns of them. The same with Dell, and again, as I just mentioned before with Sony, they're only paying 32.55%. So if they want to, they can definitely increase the dividend and or the buyback yield. Next, we want to take a look at the earnings per share and growth. First, we can take a look at the P ratio, which is just an indication on how expensive the share price is compared to its earnings. And Apple actually looks a bit expensive here on 34.78. HP, really good, 10.28. Dell, acceptable, 23.92. And Sony, okay, 14.99. So there's a little bit of difference across the board. Next, we want to take a look at the earnings per share growth cast for the next 5 years, benchmarked against the industry. All of them are not expected to grow as much as the industry, but these are also very old established companies, so there's not too big surprise in that. But what we can see is still decent 12.60% on Apple, 9.34% on HP, 3.83% on Dell, and 5.20% on Sony. I think these numbers are actually quite okay overall. We can also take a look at the revenue growth for the past 5 years. We can see all of them has managed to grow its business, although Sony appears to be stagnating a bit here with only 0.89%. You can also take a look at the net profit growth for the last 12 months. Apple becoming more and more profitable, so that's really good to see. Here, a big concern for me, HP minus 32.22, so their profitability is decreasing. That's really not a good sign. Dell, on the other hand, looking really well here with 68.23%, so that's really good to see. And Sony, despite actually becoming less profitable with minus 15.37%, it's actually good compared to their sub-industry. But again, for me, this is a little bit of a red flag because it gives an indication that Sony, both in terms of revenue and in terms of profitability, is struggling a bit. The new PlayStation 5 is coming out this year, so maybe that will turn it around, but need to be a little bit cautious with Sony as far as I can see. So what we just saw on the shareholder yield part was that all of them was actually paying quite well yield, but HP and Sony was standing out, followed by Dell and Apple. On the EPS growth cast for the next 5 years, it was not looking fantastically, but Apple, HP, Sony and Dell are all expecting growth, so that's at least good. Apple was standing out as the best. On the net profit growth for the last 12 months, Dell was exceptionally well here. Apple, respectable compared to how big it is. Sony was looking good compared to the industry, but I'm a bit concerned about their minus there. And HP was looking really poor from a net profit growth, so a bit concerning with them again. Finally, we want to understand whether these companies are currently under or overvalued, and we have different ways of doing that. One way is to look at the price to earnings to growth ratio, the PEG ratio here, which according to Peter Lynch, if this is below 1, the companies are considered undervalued. If it's above 1, they're overvalued. And as we can see across the board, all of them are considered overvalued. However, HP here only has a 1.11, so not too far to go into undervalue territory. We can also take a look at my own estimated intrinsic value, and based on that, I believe that there's a fair value upside estimate on 4.93% on Apple, small downside on 1.63% on HP, small downside on 3.81% on Dell, and a big downside on 30.04% on Sony. So the biggest downside by far is here. If we can also take a look at the beta ratio, which just shows the stock's volatility in relation to the overall market. If it's above 1, it's more volatile. If it's below 1, it's less volatile. And we can see Apple more volatile, while as all the others are close to follow the market, but a little bit less volatile. We can also take a look at some other value indicators. One of them is to look at the book value ratio. And here, if it's above 1, they're considered undervalued. If it's below 1, they're considered overvalued. And as we can see, by far here, all of them are considered overvalued. The last one is the relative strength index for the last 14 days. We want this to be below 30 because it means that it's oversold and it may go in an uptrend. On the other hand, if it's above 70, it is in overbought territory and it may do a pullback. What we can see in all the stocks is that they are in the middle, and there's no clear indication as of today whether this is in an up or a downtrend from this perspective. We can also take a look at the analyst recommendation and then don't follow them blindly because they sometimes have their own agenda. However, it's always good to see if my numbers are showing the same as them. It gives me sometimes usually a bit more confidence, of course. So we can take a look at their consensus price target, which is just the middle ground of all the estimates of the analyst. Some will have higher, some will have lower. And what they say is that there's a downside on 3.87% on Apple, so a difference from what I'm seeing. Upside on 1.06% on HP, so a small difference from mine. 8.97% downside on Dell, so we are seeing more or less the same, and a big upside on 31.91% upside on Sony, which is a huge difference from mine 30.04. That's how it is sometimes. And that's why you need to be sometimes careful with what the analysts are saying. I'm not saying that their numbers are wrong at all, no doubt, but sometimes they just have reasons for why they're putting out a certain price target. So don't take them for granted. All right, so finally we took a look at the overall value assessment of these companies, and what we determined is that Apple and HP are fair valued as of today. Dell is overvalued, and the same with Sony. Although the analyst just said that Sony is undervalued and there's a big upside, I just don't see the justification when you look at both the revenue growth, the profitability for the last 12 months, etc. It's just not telling the story that Sony is growing its revenue or becoming more profitable. So I cannot really see from today's price that there's a huge upside on them. Alright, so to sum up the video today, we do not see any clear obvious candidate. However, we would say that based on the numbers that we are looking at, Apple is by far the most solid overall company of all of them. HP and Dell has some very strong sides, but also huge negatives, and Sony is doing quite okay across the board, but there's concerns on their profitability and revenue growth. So based on this, the stock that is quite far from its 52-week high, it has a new super cycle which is predicted for its key product. We'll tell more about that in a second. It has a high net profit margin of 21.33%. It has revenue growth that is higher for the past 12 months than the 5-year average. And the stock continues to improve its profitability. Our top selection is going to be Apple. Apple does not look that cheap as of today still. They are reporting earnings in a few days. We would not hold any positions into earnings, although Apple has a history in general of beating its earnings, and we actually also have a feeling that that will happen this time. As for HP and Dell, more specifically, the primary concern we have with them is that they're very much focused on the computer laptop business, and although that has seen a quite big growth in the most recent months due to a lot of people having to work from home, so they have been out investing in new laptops. The trend is that in the future people are switching more and more to smartphone and tablets, and that will hurt both HP and Dell. Sony, on the other hand, struggling profitability-wise and revenue-wise. I'm a huge PlayStation fan. I'm very excited to see when the number 5 is coming out later this year, and that may be a small game changer for Sony. However, there are other companies who are increasing the competition within their domain. Microsoft is doing big acquisitions, so I'm not too sure how strong Sony's position is going to be in the future, and that is a bit of a concern to me. So again, overall, we just feel that Apple is the best and most safe play, and we would urge everyone to keep an eye on Apple stock for the next 1 or 2 months. The simple reason is that the iPhone 12 is going to come out, and as we mentioned up here, this is the key product still for Apple, and there's huge expectation that there will come a super cycle where people will buy this product because it's going to change to the 5G network. So if that is true and that holds up, sales should be picking up quite significantly for Apple. And we think that if there comes a dip in the share price, that will be a good opportunity to accumulate some shares. But keep in mind, we are not professional financial advisors, and this is only done for entertainment purposes. We hope you enjoyed this video. Please subscribe for future content. Give us a like, provide a comment, especially if you have suggestions for improvement. It's always appreciated. Besides that, have a good day and stay safe. See you next time.